Hey, what's going on, PFR Nation? This is Kevin Lau, your host of the Planning for Retirement podcast, and I'm really honored to do this whiteboard fireside chat. We're going to be doing a two-part series on tax efficient charitable giving. Obviously, in the wake of Helene a couple of weeks ago, that impacted much of the Southeast, including the Tri-Cities and in North Carolina and the Asheville area, as well as, of course, the state of Florida. And then, of course, we've got another storm set to make landfall tonight, Milton. And I've just been hearing a lot of individuals that are wanting to give to charity, that are wanting to find ways to help out, and it really makes me optimistic about where we are as a nation. That we do love one another, we do love our neighbors, and there are still good people out there. Okay, despite what the media is trying to tell us. And so again, what I thought I'd do is I do a whiteboard fireside chat. I'm going to do two different parts. Because many people are a little bit confused on how charitable donations work, whether or not they're deductible or not. So again, we're going to do this whiteboard fireside chat. Part one is going to be sort of high level how charitable donations work, and then a specific solution that could help if you're not able to itemize those deductions on your tax return. And then part two, which is going to be this Saturday, is going to be another video specifically for those that have IRAs and that are over the age of 70 and a half and want to donate to charity tax efficiently as well. So without further ado, why don't we jump into the whiteboard? Let's first start with overall donating cash or securities. These are really the most common ways to give to charity, is obviously just writing a check directly to the charity, or paying with a credit card, giving cash, whatever that might be. Obviously, giving cash is a little bit tough. You probably want to do some form of electronic payment. That way, the nonprofit can track those receipts. But the other way is to donate securities or appreciated stock. So a couple of key points on this one is there is a maximum amount you can deduct on your tax return based on your AGI, and it's different. So if we're donating cash, the maximum you can deduct on your tax return is up to 60% of your adjusted gross income or AGI. Okay, so if you make $100,000 and you donate $90,000 of cash to charity, you can only deduct 60% of your adjusted gross income, which is $60,000. Okay. Now you can carry those unused deductions forward. Okay. So it's not like it's a use it or lose it thing. It doesn't mean you shouldn't donate more than 60% of your AGI if you have the ability to do so. That's the key. If you can donate 60% of your gross income, great. Most of you are probably not going to be doing that, so you're not going to have to worry about it. But just be aware there is a cap on how much of your adjusted gross income you can deduct. Okay, if not for securities or for let's call it appreciated stock, it is 30%. 30% of your AGI. Okay. So again, if you make $100,000 as your adjusted gross income and you donate $50,000 worth of Apple stock as an example, you can only take a tax deduction for $30,000. But again, you can carry forward those unused losses into future years. Now, why would someone give away a stock? Is because maybe you've got a significant capital gain in there. Okay, so maybe that Apple stock that you donated of $50,000, okay, we'll call it Apple, is worth $50,000, but maybe you only paid $5,000. Okay, so you've got a gain of $45,000. If you were to go ahead and sell that appreciated stock, you're going to pay taxes on $45,000. And assuming you held that security for longer than 12 months, most likely if you had that kind of appreciation, you did hold it longer than 12 months, then you're going to be taxed as a long-term capital gain. If you held that asset fewer than 12 months, you're going to be treated as a short-term capital gain. Okay, so that's really the main difference. Is a long-term capital gain is going to have more favorable tax brackets, whereas a short-term capital gain will have that'll be treated as ordinary income. So it'll be subject to a higher taxable amount. Okay, but that's really just the basics of donating cash versus donating appreciated stock. Okay, but the caveat there is, just because you donated, let's say you did donate, I don't know, we'll call it $50,000. Actually, that's a bad example. Let's say you donated $10,000. Okay. So let's say you donated $10,000. Now, the hurdle that you need to think about is, are you even going to count that as a tax deduction at the end of the year? Okay. So there's something what's called a standard deduction, and then there are itemized deductions. Okay. So itemized deductions is basically, you're adding up all of your potential tax deductions. Okay. You haven't deducted it from your taxable income yet, but you're adding up all the potential tax deductions. Okay, so for itemized, you're going to have things like, mortgage interest. Okay, you're going to have, of course, the charitable donations, which we just mentioned, charitable contributions. You're going to have SALT or SALT, which is state and local taxes. You might have some medical expenses, assuming they exceed the amount that exceeds 7.5%, 7.5% of your adjusted gross income. Okay, so if you add all these up and they exceed the standard deduction, then you're going to itemize. And then your charitable contributions matter. But if you add up all those deductions, and let's say you don't meet, or let's say you don't exceed the standard deduction, which for 2024, for individuals or singles, I should say, singles, it is 14,600. And for married filing jointly, the amount is 29,200. And there's an additional deduction if you're blind or if you're over the age of 65. But basically, if you don't exceed these amounts, your charitable donations don't necessarily impact you from a tax perspective. You could donate that $10,000, and obviously the charity is not going to pay taxes on that. But if, again, your total itemized deductions did not exceed these amounts here, really that donation is not going to move the needle, okay? And so many people will kind of come to me and say, well, hey, what are some other ways I can give to charity but still take advantage of those particular tax deductions that I otherwise wouldn't have received? Now we enter in strategy number one. So you can itemize. Strategy number one, and what we're going to talk about today, is what's called a donor advised fund. Okay, and then strategy number two, which is what we're going to talk about, I'm going to post that video on Saturday, is going to be called qualified charitable distributions. Okay, and this is, again, for folks that are over the age of 70 and a half and have a traditional IRA in their name. Again, we're going to break that down in the next video. But the one we're going to talk about today and we're going to hone in on today is this idea of a donor advised fund. So what is a donor advised fund? Simply put, it is essentially an account that you set up just like you would any other brokerage account or IRA or Roth IRA. You set this account up with whatever custodian that you choose, okay? So you could set it up with Charles Schwab. You could set it up with Fidelity. Doesn't really matter. As long as it has the characterization of a donor advised fund, you can make contributions in to this donor advised fund. We're going to call this a DAF, okay? So you can put money, cash. You can also donate securities as well. So again, that appreciated stock example that we mentioned earlier with Apple stock. Let's say, you're like, hey, I'd love to give to charity, but I want to take advantage of this tax deduction and I can't itemize the deductions. I'm taking a standard deduction. So why would I set up a donor advised fund? Well, hey, listen, you can now front load or sort of do bunches of your contributions that you ultimately want to give to charity at some point in time, but you can bunch those contributions into one tax year. So let's say you normally donate $10,000 on an annual basis, but $10,000 is not going to move the needle in order to itemize your deductions based on all of your other deductions not being in excess of the standard deduction. Well, here's what you might think about doing is you say, hey, you know what? I'm going to take the next 5 years of my donations. What's 5 years times $10,000 a year? That's $50,000. And I've got some Apple stock I want to contribute. Maybe you have some cash, but let's say you put in $50,000 in total into this donor advised fund. Well, let's say you're married filing jointly. The standard deduction for married filing jointly, like we just mentioned on the last slide, is $29,200. Right then and there, $50,000 is in excess of the $29,200. So right away, by contributing to this donor advised fund, you take the tax deduction in the year you contribute, and now you unlock the deductibility of those donations, whereas otherwise they would not be deductible. You get them into the donor advised fund, and then you can choose to donate the funds as you choose. The key is it's an irrevocable gift, and it must come out to a qualified 501c3 organization, which is what we're going to talk about in just a second. But you can do that over the course of 5 years like you intended to. let's say all of a sudden you did that for 2 or 3 years, and all of a sudden the charity went belly up and they're not even in existence anymore. You can switch your distributions to a different 501c3. So you're not locked in to donating to one specific charity. It could be for multiple charities over the course of your lifetime and even the lifetime of your beneficiary. So you can name a successor owner or successor donor that is going to control the donor advised fund when you are no longer here. So it could almost serve as a multi-generational legacy play for not only yourself, but also your family members and the next generations to come. Okay, so that's really the basics of the donor advised fund. Okay, now what do you do with the funds that don't come out of the as a charitable donation in that year? You could just let that money sit in its cash account, or you can invest in securities. Most of the time, they're going to be mutual funds, maybe some ETFs. Typically, I've never seen a donor advised fund that accepts individual stocks or individual bonds, but most of the time, you can invest in ETFs or mutual funds. And you can essentially allow for those dollars to actually grow in excess of what you contributed initially. So you might put in $50,000 and plan to give $5,000 or $10,000 for the next 5 years, but all of a sudden you might have some growth and you might have some compounding interest over and above that 50,000, and maybe you now have an extra year or an extra 2 years of additional donations where you can give another $10,000 just because those funds were invested in that account. And the beauty is, once the money is in here, you're not going to pay any taxes. Okay, so there's no tax on any distributions. Obviously, if it's going to a 501c3, that charity is not going to pay taxes either. And then there's also no tax while that money is compounding within that donor advised fund. So again, it's a really powerful tool for those of you that are not able to take an itemized deduction at this point in time by just contributing a normal contribution for charity, but maybe you had a little bit of a windfall. Maybe you've got some excess cash, from the sale of a property or the sale of a business, or maybe you had a really high income tax year. Maybe it's from a bonus, or maybe, just overall your company is doing well and spitting out some profits. Maybe that's a year you want to contribute to your donor advised fund, take a higher deduction over and above that standard deduction, and let those funds cook and compound for future charitable giving. Even if you don't know what charities you want to give to over time, you don't have to designate a specific charity up front. You could essentially just leave the money in the donor advised fund and decide to give to different charities as you wish. Now, the key to all of this is it must be a qualified 501c3 organization. So it must be a U.S. charity. All right. And so I posted a couple of screenshots here. If you just go to the IRS website, and you can see in this little search bar here, I just put in tax exempt organizations, and then you'll see this result pop up, tax exempt organization search. And then this will pop up here. And I just put in the East Tennessee Foundation because that's what my family and I, we decided to contribute there after Helene, just given we've got family in Kingsport, Tennessee. Also, one of our team members, Amy, she's from Kingsport, Tennessee, and has a lot of family there. And they were significantly impacted by the flooding from Helene. And you can see East Tennessee Foundation, it checks out. They have an EIN number. It is a legitimate charity, headquartered here in Knoxville, Tennessee. But anyways, that's sort of what you can do to kind of double check, hey, making sure it's a qualified U.S. 501c3 organization, and therefore those distributions on the back end from that donor advised fund can be tax free. And that goes for just contributing cash and securities as well. I mean, you want to make sure the charity is legit. You want to double check. This is a way you can do that. There are also some others out there as well, some other third-party organizations. GuideStar is one of the most popular ones that you can even do some more digging and research on that. But they also have, if you dive into this thing, they've got their tax returns that are on file, so you can kind of look into the organization to see what they're doing with the funds that they do receive. But, like I said, for me personally, for our family, we decided to donate to this East Tennessee Foundation, and they have a specific fund dedicated for disaster relief in East Tennessee. It's called the Neighbor to Neighbor Fund, Disaster Relief Fund. So again, that's what we decided to contribute to. But again, our hearts go out to all of those that were impacted by Helene, and we're just really praying that everyone stays safe during Milton. I know, like I said, it's set to make landfall tonight, but we just pray that everyone stays out of harm's way. If you're in an evacuation zone, make sure to evacuate. Make sure to have enough supplies to prepare for power outages and things of that nature. And again, for all of you that are donating or making financial contributions to whatever charity you decide to contribute to, there are plenty out there. I know the folks that were impacted greatly appreciate it, and they need it drastically at this point in time. So that's it for today's fireside chat, everybody. Again, I'm going to be doing another video shortly here on the qualified charitable distribution. So if you're, again, over the age of 70 and a half and you have an IRA and want to understand the mechanics of a qualified charitable distribution, make sure to stay tuned for that next video that I'm going to post on Saturday. And of course, make sure to like this video if you're finding value in this. Make sure to share it with a friend or family member, and also make sure to subscribe to our channel. Again, it helps us not only impact you, but also helps us impact more people, which is what we're all about. Until next time, PFR Nation, this is Kevin Lau signing off.